Hey everyone, welcome back to another podcast episode. I have Terrence Doyle in the studio today to talk about a 41 unit multifamily property in the West Highlands, right around 32nd and Federal. He has under contract. Terrence, how's it going, man?
Dude, it's awesome. It's like 40 plus degrees outside. It feels amazing, and I'm happy to be back here in our newly renovated studio, ready to record a great podcast.
I know, I'm excited about this one because you even told me about this deal, and you started running me through it before we hit record on here, and it's even better than what we talked over text message. So give us a rundown. Like, what's the overview of the property? And I'm assuming everyone knows who Terrence, give us a quick background about who you are, Terrence, for those few people that know who you are yet.
Yeah, a little bit of a background. I went to school in Denver at Colorado Christian University. I started a company in college. I've been an entrepreneur basically my whole life and started buying foreclosures at the Denver Public Trustee sale in 2008. So got really fortunate with the timing. We kind of rode that wave 4, 5, 6 years, to 2013, 14, flipped like 500 or 600 homes in that period with 3 or 4 partners here in Denver. Had a good run, and then I really decided to sink my teeth into real estate full time in 2014 and stumbled upon a couple of duplexes. I speak fluent Spanish. My family's from South America, so I was able to put together a construction crew rather easily, and then was able to kind of scale that, just being able to do the same cabinets, same countertops, same tile, paint, same finishes on basically every unit that I touched.
Your assembly line is your metaphor for it.
I was able to build an assembly line for construction, and then I realized that was going to be quite a competitive advantage. So that was a key in 2014, and then on that first duplex, we were basically doing everything. We were leasing it. We were collecting the rents. We did all the construction. And when we went to sell that, we realized that in the multifamily, and these were just duplexes, but we realized that every $100 we raised rent was worth about $20,000. And back then, core Denver was trading at about a 6 cap, 6.25. So every $100 you raised rent, it was worth $20,000 on the back end. This is coming from a flipper's mindset mentality. That's how I viewed it. Like, okay, I buy it for X, I put in Y, and it's worth Z, right?
And you're talking about the income approach
That's
here, based
exactly.
off like net NOI and cap rate.
That's right. And I didn't even understand that, in 2014. So fast forward, we had a really good success with those duplexes that we bought in 2014, 15. Ended up buying a couple 4plexes. Then we were buying 8plexes and 10plexes. And then I started buying in Des Moines with my brother. And it just kind of scaled from there. And so currently we own about 400 doors in Des Moines that we own and self-manage. Same strategy as when we were flipping. We're buying outdated, underutilized buildings that we come in there and kind of bring them to life. So we do new bathrooms, kitchens, and really with the emphasis on who the tenant's going to be, what the demographic of the neighborhood is. And so it's just been kind of a just brick by brick, slow progression of going from single family to small multifamily to medium-sized multifamily. And, currently we're trying to get into the 100-plus multifamily space. In Denver, that's pretty difficult, so we still play in this kind of 40 to 50, 60, 70 unit space as well in specific neighborhoods. And this particular property happens to be like 6 blocks from another project that I've worked on for 2 years that we currently own in the heart of the Highlands. And so we just, so it all kind of came together. But that's my background, really focused on multifamily. I've done, every year I'll buy 1 or 2 flips just based on relationships and kind of timing. But my core
and also
focus,
some meaty margins.
Yeah, if the margins make sense. But my core focus every day is just multifamily. How do we scale? How do we look for larger buildings where we can increase NOI through lowering management expense and through increasing rent through construction, through cosmetic or CapEx construction, just improving the property and really offering investors a great solution for yield, for immediate cash flow, distributable cash flow on a quarterly basis with some upside, and then offering our residents a community just a safe, comfortable place to live at an affordable price. So we normally are $500 or $600 under a Class A building within 6 blocks, but you're going to have the same finishes. So that's kind of the, on both sides, that's kind of the value proposition, which is really where the name of the company comes from. Value Add Real Estate is we're trying to add value to investors, giving them upside with current cash flow yield, which is really hard to find in today's market, and then offering residents that stay in our communities just a great experience for where they're going to call home.
All right, well, let's jump into this deal because, like I said, this is a 41 unit in the West Highlands, which is a very popular and great area in Denver and a hard area to get properties.
That's right, yeah.
But, what's interesting is, as you're telling me about how you got this deal, is, about, I think 2 months ago, you and I recorded our individual podcast and our goals for 2021.
Right.
And you were telling me that a couple weeks after that, you just sat down with half a dozen
Right.
of the brokers and relationships you have, like the top relationships you have,
Right.
and said, hey, here are my goals. Here's my buybacks. I'm looking to scale up. Tell us about that conversation, because that's what led to this deal.
That's right, yeah. And it just goes back to fundamentals. Coming from a sports background, I think a lot of this stuff, that you see people talking about and doing, it boils down to like they did one or two things really well on a fundamental level. And so starting 2 or 3 years ago, every year at the end of the year, December, I'll look back on the year previous, kind of see what we did well, and put together goals for the next year. And, I went through this process in December. We went up to the mountains. You were talking about your company goals. We went over our company goals. And the big thing for me was it's about the same amount of energy to do a 10 unit, 20 unit, or a 40 unit. So naturally, my goal in 2021 was to do some larger projects. We have the construction, we have the property management, we've got the capital relationships. So if you're going to spend the same kind of energy, you might as well do some larger projects and add a zero, as I like to say. So I sat down with the top 4 or 5, maybe 6 guys that I do deals with in Denver, and basically showed them our buy box for 2021, which basically just was what our investors told us they were looking for.
When you say buybacks, like what exactly do you mean? Like you sat down and gave them a piece of paper?
Yeah,
like,
I did. I printed it out.
There?
Yeah, I printed it out. That's right. Yeah, so I printed it. So I went through with Ben, our CFO, and we basically went over like, what does a deal look like for us in 2021? If our average purchase price in 2020 was $5 million, and we were trying to take that to $10 million in 2021. So I basically went through and said, okay, we need to be able to add a minimum of 20% to rents after construction. So that's a deal for us. If current rents are $1,000, and if we can go in there and do new cabinets, paint, and flooring for $6,000, and we can get rents to $1,200, that's something that checks the box for us. That's a deal parameter for us.
Okay.
So we were looking at, we need to be able to increase rents a minimum of 20%. We need to be able to have immediate cash on cash of a minimum of 6%. So when we buy the property, we want to be able to have distributable cash flow of at least 6%.
Why is that?
Right
is that
now,
just downside conservative risk?
Well, that and, me personally, like if I have money sitting in the bank, it's earning 0.01%. Back in the day, CDs used to pay you 2%, 3%. The current treasuries at like less than 1% or something. CDs are paying you less than 1%. Money markets are paying you way less than 1%. So what I think there's a problem, one of the problems in the market that we are going to solve is that there's very difficult to find yield. Due to the pandemic last year, even some of the top publicly traded companies, terminated their dividend. I think, MGM stopped their dividend, Wynn stopped a bunch of companies aren't even paying a dividend that historically have paid dividends. So then there's a hole in the market for yield, for like mailbox money, right? Of this thing. So that's one of the things that our investors, that have created a lot of liquidity for themselves. And now they're like, what do I do with it? There's reports that have come out over the last 2-3 months that there's more cash. There's so much liquidity in the market based on, what our government has done due to the pandemic and in response to it, that there's so much liquidity in the market. The stock market went bananas the last 8 months. So there's a ton of liquidity. People have money, but they don't have cash flow. They don't have something that's going to produce yield. And so that's one of the things that our focus is on this year is we want to be able to produce not only current yield, but upside. That's something I want. That's something that our investors want. And so when I sat down with brokers, that was the emphasis, is that even though in the past I have bought buildings that we would take to zero. I've done it in Des Moines, done it in Denver, done it 100 times. We buy a building, it's completely dilapidated, just like Tennyson, the deal that we did together.
Yep.
It's like I've done that so many times and it's great. But for the current environment, when we're trying to produce yield, that's not going to be the play for us. That's not where we're going to get yield, right? Because you take the property to zero, so there's no income.
And you're talking zero vacancy and zero rental income when you say take to zero.
Exactly.
Right?
Yeah. There's no rental income because there's no tenants, because the property's in such bad condition, no one's going to live there. So then you have to help everyone find a new place to live, renovate from the ground up, and redo every square inch of the place. So now what we're looking for is more like a C property in B locations, in locations that are core Denver neighborhoods that we know really well, that we know when we come in there and give it a facelift, we're going to be able to rent to really good tenants, good residents. They're going to want to live there. They're going to pay us on time. They, have careers and, that kind of thing. So that's how you get yield. And so we're buying. So the goal when I sat down with the brokers was, those deals are great when we buy a building that's completely outdated, it's half vacant, and we come in there, we buy it for $10, we put $4 in and we sell it for $20. Those were great deals. We, doubled our money and we're in and out, but it doesn't create and solve for the problem that people are looking for, which is, current cash flow, mailbox money, right? And so when I sat down with them, I said, look, those were great deals, but going forward, I don't really want to look at that. So that was kind of a big mindset change for me and for the brokers, because normally they've said, hey, even if a property has a 0% current cap rate, Terrence would buy it if he can build it to a 7. If after construction and stabilization he can get to a 7, that's a deal he would do. So that was a really big mindset shift, but something that based on the market and based on talking to our capital partners was like a really big emphasis moving forward. That we see that in the economy the next maybe 12, 24, 36 months, that yield's going to be really hard to find. So if we can create that, we're going to have strong demand. So that was a really big emphasis. And so that was the punchline for me is I want to buy buildings that are outdated. There is value add. However, it needs to be a building that's already stabilized. So that it needs to have a current occupancy of over 90%. And we can still...
Is that a hard and fast rule is 90%?
No, we would do something a little bit below that, but that was kind of the number that we started with, was that it needs to be stabilized. It needs to have current cash flow, distributable cash flow. And we need to be able to show that through lowering management expense. So some of these buildings that we're looking at have inflated expenses, either due to really high maintenance, due to high management, rates, because every management company has different rates. So because we have so many doors in Denver, we're able to lower that expense. Because we have in-house maintenance, we're able to lower that expense. Because we have in-house leasing, we're able to lower that. So that's one of the things where we can add value. And then the other thing is through what we do really well, which is construction. So if a building has outdated cabinets or doesn't have washers and dryers or doesn't have a dishwasher or has carpet that smells really bad and needs to be replaced with, plank flooring, things like that, of that nature. Or if it has, popcorn ceiling and walls, there's all these things in core Denver with these buildings built in the 60s and 70s that tenants, if that problem is solved, are willing to pay more. And so that's still our core. So we're still looking to add value through construction and management. The difference really was, and the message in December was, we need to have stabilized buildings that we can just turn slowly. So we can continue to collect rent from the residents that are there, and then maybe we can renovate 2 or 3 apartments at a time, and then replace with market tenants, and then slowly the NOI is growing, over time. So a slower turn versus clearing the entire building was basically the message.
Now, one of the things that you and I talked about 2 months ago is that you were scaling up. Did you give them like a floor for unit size or dollar size? Or did you just kind of say, hey, I want to scale up more in this bigger stuff, like we're ready for that? Yeah,
my message was I want to do 70 units and bigger.
Okay.
So the reason why this building is 40 units is because I own 25 units down the street. So basically it got us to 65, 66, 67 units.
I mean, your other building is 6 blocks, you
6,
said?
7 blocks away. Yeah, you can walk there.
And as a reminder, because I was actually looking through this yesterday, so that property, we actually walked it on the Bigger Pockets Real Estate Ride-Along show.
That's right.
I don't know the exact, I think the title says 23-unit apartment value add in Denver, something along those lines. You go to the Real Estate Ride-Along show, it's the 23-unit apartment building. That's the other one you own. And
that's right. Yeah, it's on YouTube. We went through, walked it. You can see the renovations we did.
Too.
You can see the numbers. Yeah. And then there's a duplex next to it that we own, and then we put a parking lot in the back, so that's why that's 25 units. We just toured the 23 on YouTube, but you can get a really good feel for kind of the renovation that we did there and the renovation we're going to do in this project. And so because we own that building, the economies of scale made sense for us to do this 40 unit. But when I met with the brokers, the goal was 70 units or more. And 70 units, in my mind, is we can have full-time maintenance, full-time leasing. So it just creates economies of scale. So
that's the threshold.
That's the threshold for me. Yeah, people have different. Some people would say 100. Some people would say 80. For me, it's 70. That makes sense for our business model. And that was basically the overview. So I showed them a spreadsheet. I showed them the numbers. Showed them the cash on cash. Showed them the the.
And what was the response that you met all these guys?
It was the same thing when I was going from flipping houses to meeting with apartment brokers that were doing 10, 15, 20 unit apartment building. They were like, oh, it's going to be really hard. It's really tight, above 70. There's a lot of it's not like they were all like, man, that's a great move, because it makes their job harder and it's more difficult. Whenever you're trying to do something new, there's going to be challenges.
Yep.
So it wasn't like I was embraced with open arms. I definitely didn't get cookies in response to that. But I think I was just very clear that, hey, my track record is I create some goals and I create a buy box and then I go hit it.
Yep.
And I'm either going to do it with you or I'm going to do it with someone else. So I've got the capital, I've got the infrastructure. If you want to do deals with us this year, this is what we're looking for. And, some people haven't called me since then, and other brokers have been calling me every week. So there's some brokers that are like, hey, he's a real buyer. We're going to work a little extra hard to go find this. So that was, I also met with one or two new brokers that I'd been talking to for the last year, and that deal in a little bit higher space, that deal, in the $10 to $40 million space in Denver. And that was good. And, I've done that kind of that reiteration of introducing myself and having to prove myself and those kind of things. But I think, for the viewers listening, I think one of the things to realize is that whenever you're trying to do something new, it's going to be difficult. There's going to be some challenges, some hurdles to get over, and you just have to embrace that and realize that's going to come along with the journey and the process of trying to grow a business, which is ultimately what I'm trying to do. Is I feel like we have a really good handle on these smaller buildings, and we've had a great track record there, and now we're trying to grow to become more, really ultimately just more efficient. When you have larger buildings, it's just so much easier to collect rent, to handle maintenance, to handle leasing, and so it just makes sense. But I had to prove it on the smaller level in order to grow. And yeah, I expect this year, we may not do as many deals as we've done in the past, but I think long term, it'll be a really beneficial process for us to go through, and we'll end up being just better for it. So.
And this deal came from one of those conversations.
Absolutely, yeah.
6 weeks ago, 8 weeks ago.
Yeah,
right?
So I met with this particular broker maybe like the third week of December, right before New Year's, after Christmas. So yeah, after Christmas.
All right, so we're talking 5 weeks ago.
5 weeks ago. And then literally my phone rang from him, and it was actually on a weekend. And I believe I was out of town.
Well, that's odd for the commercial world.
He called me on a weekend, and it might have been the first weekend of January, and basically said, look, this property was under contract, and the buyer was in a 1031 exchange. This seller was one of their top clients that they've done a bunch of business with. And he said, look, the seller doesn't want to go to market, but if we go to market, we're going to go to market well above what this current buyer's under contract for. And the current buyer will assign it to you, but you have to make a decision basically in like 24 hours. And so pause right there. Because I own the building and because of the relationships I have built, he knew that I owned the building 6-7 blocks away. So I knew the area. We had just leased up 23 units. So I knew what the market was for leases. We had just finished the construction, which was a really long construction process. So I understood what the expenses were going to be per unit. And I knew exactly the scope of work that I wanted to do, because I wanted to basically just mirror the finishes that I'd done there. So I knew, I had a really good comp. So that allowed me to be able to make a decision really quickly. And I think literally by Monday at 2 p.m., he called me at Saturday, maybe in the afternoon. By Monday, we were under contract. Or we had, the current buyer had assigned it to us, and we were there. And then we did a walkthrough. I didn't even get a full inspection. We did a walkthrough.
How many units did you actually see during COVID?
2. I saw 2 units. There was 2 vacancies. And basically what I found was that the roof was in pretty bad shape, and there were some other deferred maintenance items. And so I was able to get the price to $8 million. I basically said, I'll buy this thing at $8 million. I'll waive the rest of the contingencies, and I'll close in 30 days. It was maybe a little bit more than that. It was maybe 35 days or something like that. But I'll close really quickly.
That's a quick close.
Yeah, if they'll come to $8 million. Because that basically gave me the buffer. And I knew that if this thing went to market, it was going to go maybe closer to 8.3, 8.4. It just depends on, how many people are in 1031s and how aggressive people are going to get. But it was definitely going to go for well above where we were. And so, the fundamentals of it were just the communication of the buy box, of people knowing that we own buildings within that neighborhood, allowed us to be able to make a decision quickly so that we could tie this up and it did not hit the market. And so super excited about this just because we know that location. And then fortuitously enough, we were parallel to this. We were doing an appraisal on the property we own down the street on Wyandotte, and the appraisal happened to come back before our earnest money went hard, and the appraisal came in at basically over $270,000 a door, and we were under contract at $195. So then I had, even more validation and more data to say, hey, you're in at a really good number. This is how banks are underwriting this, and this is going to be a great project. So yeah, it's been, we went really quickly, and that was due. And the only reason I was able to move that quickly was because of those factors.
Now, if you did not have Wyandotte, the comp down there, would you have moved that quickly, or do you know?
No, I wouldn't have been
that
able to
give you
move
the
that
confidence.
quickly.
Say, you know what?
Yeah.
Like, I can use all these rules of thumb and just pull the trigger because, like, I know all this other stuff. It just
That's
makes
right.
sense.
Yeah,
Okay.
I would not. Because I basically waived appraisal and inspection objection, which normally I never do.
How?
And so I
how
went hard
big
on
was the first
$100,000. I went hard on $100,000 in basically like 7 days. And the
Okay.
only reason
Wow.
and I would never do that with my own personal capital unless I had this data. So having the reps and having the experience in that neighborhood, knowing how appraisers were going to view that, knowing how banks viewed it, we were able to get a really great bank refinance term sheet, on that building. So all those data points gave me the confidence to say, this is something I can do and move forward and feel really good about. I would never do that unless I had those data points.
All right. So you got that. You're in a contract, and you should probably be 1 or 2 weeks from closing.
Yeah, exactly. 2 weeks from
talking
closing.
now?
Yeah,
Okay.
that's right. Yeah.
So what's the high-level business plan on here? Obviously, this is a value-add place.
Yeah.
You're buying around $8 million. What's the basic business plan?
So we're going to go in there. We're going to do a new roof, new windows. So basically so if people go to YouTube, they can see what we did at Wyandotte, that 23 unit. We're going to do new windows. We're going to paint the exterior. We're probably going to do a mural. And the mural we did on the Wyandotte building, we called it the Lighthouse. And basically everything was just about,
That was on the back
being
of
a
the
light.
building.
Yeah,
Okay.
that's right. And so we're going to do something similar. I think the message is going to be something about unity and love on this building just because of the times. We're living in crazy times. We really want to send that message to people, something positive. We need more positivity and we need more love. So we met with the muralist that's going to come in. We're going to paint the exterior. We're going to do some really cool features to the entrance. On this building, the electrical panels are already updated. So we don't have to touch it electrical.
Because that was a main problem.
That was a main issue at Wyandotte. Yeah, these are already 70 amps, so it supports everything. Has dishwasher, everything. We're going to probably take down half of a wall in the kitchen to open it up. So we're going to do a little bit of demo, and then the rest of it's just going to be scrape the popcorn. Half the units have popcorn ceilings, half don't. So we're going to scrape the popcorn in the units that do. We're going to remove all the carpet, go down with the same plank flooring that we did at Wyandotte, which looks really good. It's kind of an industrial look. We're going to do new cabinets, new kitchen cabinets, the same exact countertops as black leather, kind of looks industrial. We're going to do black light fixtures, black plumbing fixtures. We are going to do new tile in the bathrooms. So kind of the same thing, industrial, 12 by 24, kind of the same standard stuff we've been doing. And then paint all the walls, paint the hallways. And then in the back, we're going to add like a pergola, barbecue area. Behind the building, there's maybe like 1,000 square feet of space.
Just for like common
area.
Common area?
Yeah. And it actually overlooks the city. It's kind of cool because it sits up on a hill. So we're going to do that. I think that's going to be a really great amenity. We're going to improve the laundry room like we did at Wyandotte, improve the storage units. We're going to do just all the rest stuff. But we think the budget's going to be around $800,000 for that. And we have a really good comp, obviously, because we just did it. These units happen to be 100 square foot larger, which I think is going to be awesome for the residents.
Yeah, it's never bad to have a bigger apartment.
Yeah, a larger build.
So you're at like 20,000 door roughly then?
Yeah, we'll spend around $20,000 a door.
Okay, and that's when you say that's for everything, right?
Everything.
That's for roof, the backyard,
windows,
plus the remodel.
Everything. Yeah.
That does not seem that expensive to me, and that's probably a lot just due to your construction background, right? Because that's one of your secret powers.
That's
for lack
one of
a word.
secret powers. That's just, it's just something that we do really well because we have the same guys that installed the flooring and installed this flooring, same guys that did the paint, and so that just speaks to kind of the business we've built, over time. Obviously, we didn't start that way, but 7 years later, we have those kind of relationships, and we have these guys that just continually do this similar finishes. And if this were in a different zip code, we wouldn't do the exact same thing. But because it's 6 blocks away, it's really easy to just rinse and repeat. So that's what we're going to do. So we're going to buy it for $8 million, put $800,000 in. All the while we're doing renovation, we're going to continue to collect rent. So the goal is,
And so you'll have 2, 3, 4 vacancies
that's
at a
right.
time?
The goal is to have 5 vacancies at a time that we're renovating, and we'll do those in 4 weeks. So we can get in and out in 4 weeks, and then we can be leasing up. And so, the most we should ever have.
8-week turnaround time from construction to
hopefully
lease up?
less. I'm hoping that we're going to have one show unit, and we should be signing leases even before the construction is finished on a unit. The goal is to never have more than 10 vacancies at a time. So even if you have 5 under construction and 5 that you're leasing, that should be the max.
Okay.
And I'm hoping that our leasing team, and we've got a great leasing team, and I really love how we've built that out and how they work. So the goal would be that we would have less than 10 vacancies. So we're gonna have at least 30 residents always paying rent. That gives us the cash flow, and at the same time gives us the upside of the market tenants.
So like the contract process, obviously, like your earnest money went hard early on, which means, hey, if you cancel, you're giving them $100,000.
Adios.
The rest of the process, like, did you actually do a full inspection on this place, or you just, hey, you're buying as is and you'll deal with it once you close?
They sent me the inspection report that the previous buyer had. We did a sewer scope, and then I got on the roof. Everything else was pretty evident because I could see the electrical panels. It was built in 1964, and our building was built in 1963, so we knew the kind of build. We knew it had
Classic
cinder block,
all brick.
classic brick, cinder block foundation. So there was nothing, no surprises there.
Now, what about financing? Because, I mean, like, how's that break down from, like, capital that you're bringing or you're raising, and also just, like, the bank financing was like, what's that look like? Because
we had to go to someone. We had to go to a bank that we really knew was going to help us close on time because we had a short window. So we went to First Bank. So it's just a local bank that I have a relationship with. I've closed hundreds of deals with them, and basically just showed up. And they had financed Wyandotte, so they knew that we could do it. And basically said,
were they doing the refi too?
They're not doing the refi.
Okay.
We're doing that with someone else. Yeah, another bank got pretty aggressive on the refinance terms, so we went with them. That was, I had to go to somebody that I knew was going to close. So even though there was other banks that were willing to offer more aggressive terms in terms of rate and terms, so maybe a little bit lower interest rate and better terms on the loan, I had to go with someone that these guys are going to close. They're local, they know our process, and they gave me their word they're going to close.
And who cares about an eighth of a point? Just closing the
I
property,
need to close on time, yeah. So we actually, on this loan, we got it at 4% fixed for 30 months. So 30 months is going to be plenty of time. That's almost like 1.5 units a month or something like that.
What's the LTV on there?
We got 75% of purchase. So we're going to bring the equity for the construction. So we're going to raise just under $3 million for the downstroke and the construction.
Okay.
And then all the while, we're going to have, because it's interest only, it allows us to even fund some of the construction from the rents that we collect. So now, we're not going to depend on that solely, but we are going to be able to collect rents, and it's going to be far above what the mortgage is.
So let me repeat that to make sure I got this. So they're giving you a 4% interest-only loan for 30 months or 2.5 years. You're bringing down 25% down payment, and then you're also funding all of the construction renovation costs. And then when this is over in, 15 months or so, you're going to refi?
We're either going to sell it. We're going to either sell or refi. It could take 24 months. I mean, typically, this is kind of goes to our new model. Typically, in the past, we do it really fast.
Yeah.
But now we're trying to have cash flow. So we want to continue to keep occupancy as high as we can and still be collecting rents. So it could take a little bit longer. It could take 16, 18 months. And we hope, and
what have you modeled?
We modeled that we would either sell or refinance at month 26.
Okay, so pretty conservative then.
We think that we can get it stabilized inside of 2 years, no problem. And then we're going to see how the market is. If debt's still really cheap and the market's growing and the pandemic has eased and people feel more comfortable and, the job, I think a really big thing for the entire country and specifically Denver is just if unemployment is down, people are working again and everyone's making money and the rent collection is high and delinquency is really low, then we think that we're going to have a great path to an exit inside of 3 years. If not, we can refinance on an agency loan. They'll give us a 30-year AM. We're going to get really cheap debt. And at that point, it's going to be stabilized, and we're going to be able to clip coupons. We think once stabilized, we're going to be between 9 and 10% cash on cash.
Wow. So I mean, both doors are very great doors to walk through.
We can either sell it, and people can make, a great multiple on their money, or we're going to have that option of cash, the distributable cash flow once it's stabilized, and that should be north of 9%.
Okay. So like what type of guarantee did you get from First Bank? Because I mean, I've done deals with First Bank, obviously
Right.
smaller than this one, but they have their process,
Right.
And they have to go through the loan committee and all that. Like, what made you feel certain that they would close on time, or they give you any guarantees that if we don't close on time, we'll give you X, Y, Z? Which I don't imagine a bank.
Yeah,
would give
bank's
you.
never going
They're
to
not gonna give you
me
that
a
guarantee, right?
It was just a relationship.
Okay.
You know, I was just saying, hey guys, I have to really move quick. If you can't do it, just let me know. But I really need to. And so they rushed the appraisal. You know, I think they have some vendor relationships where they can rush appraisal. They rush the environmental, and they basically said, look, we're gonna get this done in
Did you
a
have to
really
do
short
phase
amount of time.
one or phase
We're
two?
doing a phase one.
Okay.
Yeah, and that's just for our investors to make sure we know what's under. Just to check the box, to make sure we're being thorough with our due diligence. But no, I mean, there's no guarantees. But First Bank, they just said, look, we understand you're under the gun. We want to earn your business. We've had a good relationship. We want to continue to keep you as a client. So we're going to do everything we can to do that. And they have a box for that they're like, if someone is in need to move quickly, they can do that. So yeah, I feel good. I mean, the appraisal was ordered, I think that same day. They've ordered the other tests that we need. And, we're going through that process with them. And, we're in constant communication. And I think we're on schedule there.
All right. So, I mean, overall, this sounds like it's a great deal. I mean, you have to move fast,
Right.
but your model, your experience, plus your comp, half a mile down the street.
That's right.
The stars align for you,
That's
basically,
right.
is what it sounds like.
Yeah.
So from this, deal, which you're, 2 weeks away from closing on, any other speed bumps or topics you want to touch on?
Well, one of the other things that we did, so two things that I think are important for people that are looking to do, more deals and scale and want to get into multifamily is, one of the things I hear is, well, there's no deals, so I don't even look at anything, or why do I, there's nothing that fits my box. I went and toured with some other brokers in this same neighborhood, other deals, while I was under contract in this, because I wanted to know the market. And so while touring it, I was able to get more data points to see what the market was for properties that were renovated or unrenovated. And one of the buildings that I toured was a 17 unit, 2 blocks from Wyandotte, outdated, a little bit larger units, and that went under contract. They signed the listing agreement. It never went to market. It went under contract literally like 36 hours after they signed the listing agreement. They signed the listing agreement on like a Friday at 8 p.m. with the seller, and by Monday at like 8 a.m. they had multiple offers, and I toured it on Saturday. Yeah, it was something like that. So maybe it was like 50 hours, but regardless, it went really fast. I toured it on Saturday with a broker that I'm really close with, and I could not believe how disgusting these units were. I mean, it literally had like dry paint, like that had dried, like it was just like dripping down, and it was disgusting. I mean, it had plaster everywhere, popcorn ceilings, yellow walls. It was the bathtubs were brown. I mean, it was like as bad as you can get for that neighborhood. I mean, it's bad. It has not been touched in 30 years, and it went under contract at $241 a door. $241 a door.
What are you under contract for?
At $195, and this is out. And I feel like ours is in much better living condition right now. And so
rents comparable, like in that, and from the
their
17
rents,
unit?
their rents might have been a little bit higher because the units were a little bit larger, but not much. Maybe like $50 more. So what they had maybe a little bit better view. They were sitting on a lower street that had maybe a little bit better view, but nothing like drastic. You're talking a difference of 6 blocks, so nothing can change that much. But I just think the action item for viewers is that it never hurts to tour properties, especially if you own something in the area or you're looking at something in the area. Tour as many properties as you can, even if, because when he told me the price, he was like, hey, we're going to go out at this number, at, maybe 4.8 or 4.9 for 17 units. I was like, geez, dude, that's insane. And I knew I could never touch that, but it never hurts to just go walk it and see it, so you have another data point to compare what you're looking at or what you own. And then the next thing that we did was we just met with the current property manager to go over what they thought about the current tenants, what they thought about rents, how they were doing maintenance. Well, they knew about Wyandotte, and they basically said, look, we can never get the rent you're getting. And so my proposal to them was, and they're one of the top property management companies in the city, was why don't you let us do the maintenance, let us do the leasing, but I love how you guys do the reporting, the accounting, the rent collection, and I love just your brand. And it's going to be my first deal with them. So it'll be really interesting to see how we work together. But they kind of knew what we were doing. They had seen what we had done in Wyandotte, and they basically said, look, maybe you can show us how you're doing these things, on the leasing side. And yeah, we were able to strike, I think, a really fair compromise of what they're good at and what we're good at. And, I think we're going to learn some things from them. And, hopefully we'll be able to be a great client for them. But I think the key was just sitting down with them and understanding, what are the tenants? What issues do you see? How is maintenance currently ran? How do you guys feel about us leasing? Just having a conversation, because not every property manager is going to be okay working with the way we do. And thankfully they were.
So they were flexible to, hey, we'll do this, we'll do that. And
because they knew that, I think they knew that they weren't going to be able to get those leases, and I think they wanted to see how we were doing it. And there's some nuances and some things we do, but ultimately it really just comes down to, they're trying to service 4,000 units, and they have hundreds of landlords and owners that they have to please, and so they're not able to spend the time on the leasing like we are. And that's basically what you find, is that if you can do it yourself, you're going to be able to do probably, I'd say 10 to 15% better than a property manager that has to do all these other things and has to, they have so many other boxes they have to check. They don't have the time or the bandwidth to spend the extra time to create videos or create extra social media, or to, go that extra mile that's going to help us get that extra 10%. And in my world, the extra 10% on the lease is what makes this, what helps us stand out from our competition and creates disproportionate returns for myself and my partners. Mm-hmm. So that's a big deal for me. That we always do that. And the same thing on the maintenance side is that we're able to lower that expense, because our guys that touch the plumbing, they're going to come back, either it's under warranty or they're going to do it cheaper than what just any plumber that, one of their vendors would do it for. So, that was a really good, interesting conversation. It was really important to make sure that I was upfront about our expectation. They were upfront about the way that they wanted us to handle leasing, and, making sure that we're protecting them, right? Because there's a lot of liability when you're leasing and showing units, and you're not the property manager on record, right? We're just going to be leasing them, and we're the owner. And so there's some things that we had to discuss there, but overall it went great, and I'm super excited about it. I think this is going to be a phenomenal project, and I really love that we're hitting this just as kind of the vaccine's rolling out and things are starting to, feels like it coming off the bottom with unemployment and some other negative metrics. And so, I love that we know the area, and it's just one of those things, just like the hard work of just being consistent and communicating and having the fundamentals dialed in of being able to clearly articulate what we're looking for. And then once you see it, being able to move quickly, all the things that we always talk about, right? If you're going to meet with people, you have to be pre-approved, you have to be ready to move, and you have to tell them what you're looking for so that they can hit it. And so just being able to execute on that, obviously I love seeing that come together.
Let's rewind that, because it's always a good thing when we do these interviews, Terrence, is to talk about like key takeaways. Because people can sit out there like, oh my gosh, what Terrence is doing here, it's just it's amazing. I can never do that.
Right.
But then you always stick to the fundamentals.
Right.
And you remember that last couple sentences really quickly, that hey, you meet with people.
Right.
You come prepared. You come with a one-page action plan that's very specific. Hey, these are my must-haves. These are my niceties, and this is what I can do. Mm-hmm. Like, you bring me this, then you execute as well. So, like, how can people replicate what you're doing? Like, what advice do you have for people listening to what you're doing now to maybe where you were, 10 years ago? Like, what advice can you give people help them grow and scale like you have?
Yeah, 100%. I mean, it's a phenomenal question. It's really the most important question of this whole episode, is that, even if you're looking for a single family flip, or you're looking for a house hack or a house with an ADU, is you have to sit down, spend the time, which is difficult, and say, what am I looking for? What is, based on my financial situation and where I'm trying to go, what is realistic, and what should I put down on paper for this year, right? So whatever that is. I'm looking for a flip in these zip codes that I can make $20,000 on. Whatever those things are that you're looking, or I'm looking for an ADU that I can make $200 a month net cash flow. And whatever it is that you think you want, you have to write it down, and then you meet with as many people as you can in that space. And naturally, the higher dollar amount and unit count you go, there's fewer people to meet with. Just naturally, there's only maybe 6 or 7 qualified people that sell apartment buildings over 100 units in Denver. So there's not that many people to meet with. But there's hundreds of people that sell flips or ADUs. So you have to clearly identify what you're looking for. You have to do the work and make sure you have the capital, either you personally or partner with someone that does, right? So you have to have that nailed down before you meet with anybody. And then you spend the time meeting with people, clearly articulating that, and then following up. And the last part is when they send you a deal that looks interesting, you have to take action. either through an email saying, hey, I can't do this in this time frame, or hey, let's go look at this, or hey, I'm ready to make an offer. But you have to take action. Otherwise,
and you have to take quick action. Don't spend 3 days to reply the email.
You have to take immediate action.
Don't ignore it, because if you do, people stop studying it.
Someone else is going to move faster than you. Yeah. And with the market we're in, in Denver, regardless of any asset class, you have to move quickly when someone sends you something, especially off market, because it's so competitive. There's an insane amount of liquidity out there. There's so many people looking for probably the same thing you're looking for. Everybody's talking about Denver. Everybody's talking about cash flow. Everybody's talking about a house hack. Everybody's talking about these, kind of like sexy, trendy terms. And so if you're looking for the same thing, you have to separate yourself, and that is through the fundamentals. And you have to perfect that, and you have to move. When someone sends you something that fits your box or even looks close, you have to communicate and act quickly. Otherwise, you're going to be put at the bottom of the list. And I think that's the message and the punchline to the whole thing, is that regardless of what stage of your investing career you're at, you have to do those same, you have to go through those same steps. I've had to do it my entire career. Even though I've, went from flipping to, 10 unit apartment buildings, 20 unit, 40, 100, it's been the same iteration every single time, and every year of here's what I.
So can I distill that down to, like, no matter where you're at, whether you're starting out or scaling up to the next evolution of your business or investing career, that no matter what, you're going to have to go through kind of same song and dance, the same process, prove yourself, network, do the same thing, but follow that formula, stick with it, because results will follow.
It'll follow, yeah. No, and I think that, I can sometimes, because I've been doing it for so long and I have built a lot of great relationships, that I can make it look faster and easier than it is. But I promise you, we put in the work. We put in the work when no one's watching, when you and I aren't recording. We're doing all the little things.
And I can tell you, we've had some of these conversations where it's like, oh my gosh, this week, like, I put out these 3 fires, like you're taking your black eyes.
Oh, for sure, yeah.
Which is part of the process.
Part of the process, yeah. It's not sexy, it's not fun, it's not glamorous, but if you want to see results and get results and create that cash flow, create that freedom, and experience those wins, you have to put in the work. And it may not be fun, and you may go several months, weeks, years, whatever the time frame is, without seeing results. But if you stick to it, good things are going to happen. If you follow up, if you are diligent with your underwriting and you're clear with your communication, and you take action quickly, good things are going to happen. Because most people are not doing that. Most people are not doing those little things, in those details and those nuances. Most people just show up and say, I want something, and expect, heaven to rain down cash or opportunity. It just doesn't happen. And so if you do the details, good things will happen, just because the sheer numbers are most people are not going to do it. And so you're going to separate yourself by doing those little things. And I really want everyone out there to apply that and try and prove me wrong. Show me that you've done that for several years and that nothing good has happened. And I'd love to hear that, because I just don't see that. When people apply themselves and do that system and that process, good things happen, and you're going to see results. Terrence, and it's really life-changing.
Yeah. Dude, I think that's a perfect note to end on. So, I mean, this was phenomenal. And just as like a plug to future things as well, like what we are doing right now with this discussion we're having is really trying to hone in the format we're doing for the new Bigger Pocket show we're doing, which is the Tribe of Multifamily
Mentors. Let's go.
So we've recorded one. We got a bunch more recording up, but it's really going to be a cool new show we're doing on Bigger Pockets, and really focusing on just the deals and relating that to like the bigger picture we've been talking about. So if you guys really like the bigger stuff, the scalability, the multifamily, make sure to check out that show, which should be launching April-ish timeframes that we're penciling.
Yeah, end of March, 1st of April. We're gonna have Q&A, live Q&As with all these guests that are flying in from around the country. They're super talented in different aspects of multifamily, either from construction, property management, being an operator, being in the financing side, broker side. I mean, we're gonna have some really great conversations. We're gonna have live Q&As on YouTube, and then the episodes will release sometime in March and April. And I'm really excited about it. I think we're gonna have we've already had some great guests. It's just going to get better. The energy that we have in the new studio is really phenomenal, and I think we're going to have some awesome content that we're going to be putting out here shortly.
Agree. Yeah. Terrence, thanks so much, man.
That was great.